Grab stock came up on the Discord this morning. By the way, link is in the description for that if you want to join the conversation. It's free for everybody. I don't believe in charging to have a conversation, and I learn just as much in the Discord as anybody else. So I remain very positive on this name and even added a little bit after thinking it over because honestly, for where they're at, I think a pullback in price for how well things are actually going may end up being seen as a gift in a year or two. They're still very much a growing concern, and they share a core business in common with a giant known as Uber. As a matter of fact, Uber's own CEO sits on the board of directors at Grab as an independent director. So Uber themselves believe in Grab. I think that says quite a lot about how they're doing and how they approach their core business, which is rideshare and delivery, especially when it comes to food delivery. So one thing I didn't get to cover on the last video where I mentioned Grab, I did talk about their balance sheet, which is exceptional, very strong. But I didn't get to talk about how their profitability profile is improving over time. Now, they don't have GAAP net income at this point in time, and this is because of the fact that they do have share-based compensation. As you can see in this adjusted EBITDA reconciliation, they add back in what was taken out for share-based compensation expense. Now, that makes sense when you're just trying to look at what the sort of operational health of the business is, because share-based compensation, vesting schedules, etc., can affect that. And they even mentioned as much. This is something that they're trying to address. They have a buyback program that they're saying they're hoping can offset a lot of this share-based compensation going forward. And now that they are adjusted free cash flow positive, that should be easier to do, and adjusted EBITDA positive. By the way, the adjusted free cash flow adjustment, in case you're wondering what that is, they basically mark down how much of the cash that came in was for people depositing in their online banking part of their app. They don't want people loading money onto there and that actually counting as free cash flow when people are trying to measure how good their operations are. So they do a similar thing with their EBITDA. They adjust it for share-based compensation. They add that back in. And of course, the usual depreciation, amortization. Interest expense really isn't much of a thing because they really don't carry any considerable amount of debt. So that's not really much of a concern. But you can see, compared to 2023, this second quarter was negative 17 million in adjusted EBITDA and up to 64 million this last quarter here. So that's a pretty substantial swing. And if they keep improving that number at this pace, eventually it will eclipse, whatever their share-based compensation might be. And hopefully they can find ways to pare that down a bit, or their buyback program can aggressively offset that, and even maybe while the stock is cheap, drive the share price up or drive value to shareholders in the future. Although, granted, right now, I don't think that they're raking in so much that I want them to necessarily be putting a ton of money into buybacks. If they have other ways to deploy that capital to grow the business, I would probably rather see them do that. So the subject of Grab's valuation metrics came up, especially as they appear relative to their nearest peer, which is Uber. So Grab's price to sales seems to hover in the 4.5 to 5-ish range, where depending, kind of on the day-to-day movement of share price, whereas Uber's seems like it's in kind of like the 3.5, 3.75 range. And I think there's a simple explanation for this. $1 of Uber freight revenue is not as valuable as $1 of Uber Eats or ride sharing revenue. The freight business, when you hire out to third parties, tends not to be an extremely high margin business. Most of your revenue goes towards carrier spend. So you could say get $1,000 to move a load from A to B. There's a good chance that 900 of that 1,000 is going straight to a third party. And then you add your overhead, and your operating ratio is what? 4 or 5% maybe. And I think Uber Freight actually does worse than that overall. I haven't looked too much at their numbers lately, but for a while they were cash flow negative in that freight business. And they may still be, actually, because the freight market's been really rough lately. And they couldn't even turn a profit on that segment in good times. So suffice it to say, revenue in that industry is not considered to be as valuable as revenue in their rideshare business and in their food delivery business. In the rideshare business, they definitely have a wide moat. The food delivery, it might be a narrow moat because of the fact that there's some other alternatives. Now, they bought some of their competitors like Postmates, etc., but I think DoorDash might still be owned by somebody else. And, there's a bunch of little boutique food delivery, and local restaurants themselves can offer food delivery independently. So, I don't know if I would call their food delivery a wide moat, but certainly they have more of a moat in both of those things than they have in freight. Freight is kind of like a race to the bottom in a lot of ways. It's just the customers in that space, first of all, they spread their risk around. They won't just exclusively go with one operator usually. Your Walmarts, your Targets, your Procters and Gambles, that kind of thing, your Costco's, they're not going to put all their eggs in any one basket, so they're not going to give all of their freight to Uber, right? You can't really establish a really wide moat in that business, and it's extremely fragmented, and where even the big operators don't individually get more than a few percent of the overall market share. It just doesn't happen. So what Uber Freight has found is that trying to make it a loss leader where they just compete on price only and try to capture market share, well, there's a limit to how far that gets you, and I think they're running up against it personally. But suffice it to say that that's why I think Grab gets the higher price to sales multiple, simply because they don't have that dragging them down. The market is sort of correctly understanding that the Uber Freight revenue isn't as valuable. Now, when you look at price, something like price to book, I think Grab really shows hey, this company has a strong balance sheet and they're only trading at 2x, the value of that balance sheet, which means that roughly half of the value of the current share price is coming from the balance sheet and half from the potential of the business, which is freakish considering that the market is correctly recognizing that it deserves a higher price to sales. So that's wild, because Uber has like a 12 times price to book or something like that. So more of the implied value of Uber is coming from the potential of the business, even though the price to sales is lower. It's kind of crazy. But all in all, I do like Grab's side business of Fintech quite a lot better than Uber Freight's freight business. So I would much rather invest in a company that most of the eggs are in the core business of rideshare and food delivery. Plus, they have their fintech thing, which, by the way, the metrics on that do get better, and it is growing fast, and it does move closer to that break-even point the larger they get with scale. So overall, I think that has better potential long-term profitability-wise than Uber Freight. I think Uber Freight is I think it's kind of stuck in a rut, and I don't think it's going to get any better from here, or not much better anyway. It's possible that it could, but I am not a big fan of that business, in case you have not been able to tell. So I think this stock would probably be pretty hard to model with any degree of accuracy. This is because as they're sort of transitioning into profitability and they're coming through that break-even stage, there could be multiple years where they throw increases to their net income and free cash flow that are so high percentage-wise that it's hard to say where they'll kind of hit a point of more predictability and stability in that. But what we can see is that they're very rapidly turning progressively more profitable in their operations. It's also difficult to figure year to year, quarter to quarter, what the currency situation will do to the growth numbers that they can report in US dollars. But all in all, I think it's going to be quite good. I'm betting on that. And the market seems to be overall kind of sleeping on how good this could be. While Uber is seemingly recognized for what it is, a really good core business, it seems that people are sort of sleeping on Grab. And part of it could be where they operate and everything like that. Now, that to me is actually an advantage. Uber is already really heavily saturated in the US, which is pretty much one of the richest markets you can be in. Whereas Grab is ubiquitous in multiple emerging markets. Granted, they're in Singapore, which they have first world money in Singapore, for sure, but it's pretty small population-wise. But they're in so many markets where not only is the population and the overall GDP growing in those places, but per capita GDP is on the rise. I love to see those trends. For example, Malaysia has a per capita GDP that I think is getting to within a stone's throw of the Chinese per capita GDP. And that's not a small country. I think they have over 100 million people there. So these are places where, as the populations have more and more of something that we would recognize as like a middle class, you'll have more people, especially as they urbanize, using rideshare services like this. Like, it's difficult in a lot of these Southeast Asian countries if you reside in a big city, to own your own car and like have a place to even park it. So I think there's a lot of room for Grab. Like, gridlock is serious in Manila if you've never been there. So I do think that Grab has a place to stay in a lot of these markets. I don't think they're going to go obsolete. And I don't think there's anyone else that's going to come for their lunch in the overall Southeast Asia. Now, they get the occasional single country competitor in there, but I think that they've got the war chest to kind of squash them like so many cockroaches. And I think that that's just what they're going to do.
I buried those cockroaches!
If you, in fact, made it to the end, I would like to encourage you to subscribe to the channel and like it for the algo. Also, very importantly, I need you to follow me on Twitter or X, whatever you want to call it. My handle there is @MrMachoMog. The link is in the description. As always, my Discord is in the description and open for free. If you want to support the channel directly, you can become a channel member, though it is not required. All that I require is your attention and your eyeballs, and Daddy Google will pay me the rest. Let me know in the comments if you have Grab or if you have another take on it. Always appreciate an interesting discussion. Take it easy, everybody.